Hey everyone, Chris here from Remmes&Co Real Estate in Boston. Today we're diving into one of the most important and honestly most misunderstood factors in the housing market, interest rates. If you're buying, selling, investing, refinancing, or even just keeping an eye on the market, interest rates are shaping everything. They influence what homes cost, what you can afford, how much competition is out there, and even the kind of strategies people use to make deals happen. So in this video, I'm going to break it all down, what interest rates really are, how they're set, how they impact you directly, and what's happening in today's market. And make sure to stick around until the end. I'll share a few strategies that buyers and sellers are using right now to navigate this high rate environment successfully. Let's jump in. So first up, what actually is an interest rate? At its simplest, an interest rate is the cost of borrowing money. If you're taking out a mortgage, you're borrowing a large chunk of money from a bank or lender, and the interest rate is what they charge you to borrow that money. Say you borrow $500,000 at a 6% interest rate. That's $30,000 a year in interest payments, at least in the early years of the loan. Over 30 years, that adds up fast. Even a small difference, say from 6.5% down to 5.5%, can dramatically lower your monthly payment. That's why interest rates matter so much when it comes to affordability and financing strategy.
Thinking about relocating to Boston? Well, I've got just the thing for you. Me and my team have actually taken the time to create the ultimate relocation guide, which is meant to save you hours of research. I've linked it down below. From top employers to the best hospitals and a boatload of other things that you need to know before you make the move. The best part is that the guide is 100% free. That's right, you heard me, 100% free. Just click the link below in the description or the top pinned comment. Hope that helps.
All right, next, where do these rates come from? Who's in charge of them? Good question, and the answer might surprise you. While mortgage lenders technically set their own rates, they don't do it in a vacuum. They're mostly influenced by the Federal Reserve, also known as the Fed. The Fed sets something called the federal funds rate, which is the rate banks charge each other to borrow money overnight. And while that's not the same as mortgage rates, it has a major ripple effect on the entire economy, including what lenders charge consumers. Mortgage rates are also tied to the bond market, especially the 10-year Treasury yield. When those yields go up, mortgage rates usually go up. When they go down, rates tend to follow. So, bottom line, mortgage rates are shaped by a mix of Fed policy, investor expectations, and market forces, not by a single decision maker, but by a complex system of financial signals. Let's zoom out now. What's the big picture history of mortgage rates? This might surprise you. Back in the 1980s, rates were as high as 18%. That's not a typo, 18%. Inflation was out of control, and the Fed raised rates to bring it down. Through the 1990s and early 2000s, rates mostly floated between 6% and 8%. Then after the 2008 financial crisis, rates dropped significantly to around 3%, 4% as part of a major economic recovery effort. And during the pandemic, we saw the lowest mortgage rates in US history, some dipping below 3%. That sparked a massive buying and refinancing boom. Fast forward to today, and we've seen rates jump sharply again, thanks to inflation and aggressive action from the Fed. So what's happening right now in today's market? As of 2025, we're still feeling the effects of the Fed's rate hikes from the past couple of years. They raised rates aggressively to cool inflation, and mortgage rates went from the low 3% range up past 7% at times. Let's make this real. A buyer who could afford a $600,000 home at a 3% rate might only qualify for around $475,000 at a 7% rate. That's a huge drop in buying power just based on interest rates. And because of that, a lot of homeowners are staying put. People who locked in 2.8% or 3.2% mortgages don't want to sell and take on a new loan at 7%. That's what we call the lock-in effect. It's keeping inventory low across many markets, including here in Boston. Now, let's get practical. How do interest rates affect you? Let's break this down into 4 common situations. First up, buyers. Higher rates mean higher monthly payments, no surprise there, but they also reduce how much home you can afford. That might mean adjusting your budget, looking in different areas, or getting creative with financing. One tip I always give, ask your lender to run multiple scenarios. Even a half-point drop can change your numbers significantly. Next, sellers. When rates are high, fewer buyers are able to qualify for larger loans. That can shrink your buyer pool, especially in higher price points. But here's the flip side. Inventory is still tight. If your home shows well and is priced right, you can absolutely still sell, and quickly. Now, investors. Higher rates mean it costs more to borrow money to buy rental properties, so your monthly cash flow might be tighter. That said, rising rents are helping offset this in many markets, and a lot of investors are switching gears from betting on appreciation to focusing on cash flow and long-term income. And finally, refinancers. If you locked in a 3% mortgage recently, you're golden. No need to refinance, but if you bought during the rate hikes and your loan is in the 6.5% to 7.5% range, keep an eye out. If rates drop in the next year or two, a refinance could save you thousands.
Hi guys, it's Chris. As much as I love making these videos, there's one thing that I love more, and that's helping families and people from all over the US make the move here to Boston. I've helped countless families make the move, so whether you're coming out for the week, the next month, or even the next year, don't hesitate to reach out. My contact information is below, right there on the screen and linked in the description in case you missed it in the on-screen pop-up. I look forward to helping you and your family make the move to Boston.
All right, so let's talk strategies. What are people doing right now to deal with high interest rates? First, rate buydowns. These are making a comeback. A common one is the 2-1 buydown, where the seller or builder pays to temporarily reduce your interest rate for the first 2 years. That can help ease you into your payment while you wait for a chance to refinance. Next, adjustable rate mortgages. ARMs were out of fashion for a while, but they're back. These loans start with a lower rate for a fixed period, say 5, 7, or 10 years, then adjust. If you're not planning to hold the property long term, this could make a lot of sense. Another strategy, put more money down. A larger down payment can help you qualify for better rates, reduce PMI, and lower your monthly cost, even when borrowing is more expensive. And here's one more, get creative. We're seeing more people explore co-buying, house hacking, or pairing up with friends or family to get into the market. Sharing the load can make higher rates more manageable. So where are we headed next? Look, no one has a crystal ball, but here's what we do know. The Fed is moving carefully now. They're watching inflation, the job market, and consumer spending closely. Most economists think rates will come down gradually, not overnight, but step by step as inflation cools. We probably won't see 3% again anytime soon, but mid 5% to low 6% rates could be the new normal in the coming years, and that's why I always say don't wait for perfect conditions. They rarely come. Instead, focus on finding the right property in the right location at a price you can work with. The rate, that can be improved later with a refinance. As they say, you marry the house, you date the rate. So, quick recap before we wrap up. Interest rates are the cost of borrowing money, and they move based on the Fed, inflation, and the bond market. Even small rate changes can impact how much home you can afford. Today's rates are higher than what we saw during the pandemic, but they're not historically extreme. Buyers, sellers, and investors are still making moves, just with smarter strategies. And going forward, rates will likely ease slowly, but planning, not guessing, is what really wins in real estate. If you're thinking about buying, selling, or investing, and want to understand how interest rates play into your game plan, reach out. I'd love to help you navigate it all with real numbers and a smart strategy. Thanks so much for watching. If you got value out of this, give it a like, hit that subscribe button, and drop your questions in the comments. I'll see you in the next one.